In this session, we will look at the various credit analysis models because measuring credit risk has become one of the important things of late for taking appropriate actions and mitigating the risk and ensuring the profitability of a financial institution. So, from that standpoint, we need to understand right from the basics what are the various credit analysis models that are there, and based on simple formulas or some basic structures and the various ratings kind of models that are available. So, we will look at all these aspects. So, to start with, whenever I talk about the word credit risk, the major thing that I am trying to derive there is any borrower resulting in either a default or delay. Both of them come under the credit risk. Any kind of a default or a delay in making a timely payment of interest and principal, whatever they have borrowed, and whatever is the initially agreed upon the schedule for the interest and the payment, any kind of delay or default as far as that particular payments are concerned, the timely payment of interest as well as principal, if at all I am feeling it as a risk, saying that there may be a delay or there may be a default, means I am exposed to risk. So, when I am exposed to risk, it's not that there is 100% chance of a risk. So, that is where we assign a probability of default. Okay, what is the chance that this person will default on this loan, or that this company will default on the loan? Again, default could be, it could result even in a delay, and both of interest as well as principal. So, what is the chance that this particular party fails to pay either the interest or principal when it is falling due? That is what we call as the probability of default. And once that party defaults at any point in time, so because I am a lender, I may be at loss, but what we are saying is that loss may not be the entire 100% of the money, because at the time of the bond agreement or in the indenture for the bond, there must have been some kind of a collateral in case the default has occurred, or there could be some kind of collaterals mentioned as a part of the initial agreement, that in case I default or in case there is a delay in the payment, the lender can have a possession of XYZ assets. So, all these things could give me some money back, or in some cases the entire money back also, even if the default has occurred. That particular aspect is measured through what we are calling as loss given default. What is the amount of loss in case the borrower has defaulted? How much I can recover? So these two words, loss given default and recovery rate, there is a lot of relationship between these two words. The loss given default is very much associated with the recovery rate. Both of them are inversely proportional, because if the recovery rate is around 90%, when I say recovery rate, how much I can recover from the other party in case the party has defaulted. So 10% forms the loss given default. If 90% is the recovery rate, 10% becomes the loss given default. So that's what is the relationship between these two definitions. So either we may state the loss given default or the recovery rate and try to derive the other. And in the credit risk world, we very well use another important definition called expected loss. Generally, when I say expected loss, it is probability of default into loss given default. If so, this is also in a percentage form. This is also in a percentage form. So the expected loss actually comes in the percentage form. Loss given default is how much proportion of money I can lose of the total money I can lose in case there is a default. Probability is what is the chance of default. So when I am multiplying these two, I get expected loss. And what it is said is, if I multiply it with my total exposure, how much of money I have lent, then it is an expected loss in the monetary terms, in the dollar terms. But if I am taking only these two quantities, then it is the expected loss in the percentage terms. So I can express it in terms of percentage of the total exposure or the dollar value of the total exposure, but that is what we call as expected loss. And what people understand is this expected loss will be different for different states of economy, because if the economy is in a boom phase, what we typically see, the chances of default are much lesser, and even because the assets value will go up, whatever have been set as a collateral, even their values are going up. So the loss given default also will come down because the recovery rate could be much higher. So what you see is expected loss will be much lesser during an economy when the economy is in a booming period compared to a recessionary kind of a period. So the expected loss is expected to change with the state of the economy. And what we typically observe is, compared to the expected loss, the present value of the expected loss is what is typically more and more important as a part of the credit risk analysis process. The present value, whenever we are saying the present value, obviously there are two things. One discounting of all the future cash flows, or here in this case, because we are talking about losses, discounting all the future expected losses to the present value. So PV of the expected losses, you expect, okay, at the end of 1 year, what is the expected loss? At the end of 2 years, what is the expected loss? At the end of 5 years, what is the expected loss? You get all of them to the present value, and you say that is equal to the present value of the expected loss. Now here the discounting, I am doing it using a risk neutral probability, not using the probability of default, because all the future losses, they are adjusted by a risk neutral probability. So probably there is a 30% chance of a loss and 70% chance of a no loss. So based on this, I am trying to come out with a risk neutral kind of a probability, and based on that I am discounting all the expected losses. So we are not using the default probability based on risk premium, just like the way we go with options. Okay, if there is a loss, I am going to get 0, and if there is no loss, I am going to get 30, let's say. So when I am using the risk neutral probability approach, the expected loss is only 21. See, when I take probability of default, we are saying, okay, 30% chance is the probability of default, and the loss given default is 100%. So the expected loss, I am taking it as 30% into 100%, which is around 30%, and doing the work. But what we are saying is, when I go with a risk neutral probability, okay, there is a 30% chance of losing 100%, whereas a 70% chance of losing something else. So we are coming up with the cash flows, which is a risk neutral probability based kind of cash flows, and arriving at the present value of them. So that is an indication, because we discount it using a risk neutral probability. Okay, the time value, the discounting which I am doing is also a kind of the discounting factor. See here, when we are bringing the future values to the present values, there are cash flows, and there is a discounting rate. In the discounting rate, I can still use risk free rate of return. The cash flows, I can make them risk neutral. Probability of default was multiplied by whatever can be recovered, plus probability of no default multiplied by whatever else can be recovered. So based on them, I get those cash flows to the present value. So the indication is, it indicates the value of the risky bond minus the value of the risk-free bond. All other things remaining the same, including the maturities and coupons and everything else. The present value, the value of a risky bond minus the value of a risk-free bond. That is an assessment of the spread, or basically the amount of credit risk that is inherent in that bond. Value of the risky bond, because the higher the risk, higher should be the expected return. So this is an indication of the value of the risky bond over the risk-free bond. And the other way also that we need to see is the amount which an investor is willing to pay extra, right? Because the risky bond, the risky bond value is something because it is paying me a better payoff, minus the risk free bond, the value is slightly lesser because the risk is also lesser in it. So the excess that is being paid for the risky bond to bear the risk that is inherent in it, to bear the inherent credit risk, whatever excess is being paid is what is adding up to the value of the risky bond. So this is how a typical credit analysis process starts off. So when we look at a risky bond versus a risk-free bond, whatever with similar kind of characteristics, whatever the difference that is coming up, that is a measure of the credit risk that is associated with the bond. All right. So one form of measurement of credit risk that we typically see is models. So typically the traditional models which fall into the category of either credit scoring or credit ratings. So these are very easy to understand kind of a models. They majorly go with an ordinal rankings kind of an approach, both of them, because they arrange the data in either, they arrange the data in either ascending or descending order of the credit risk, and based on that they assign some kind of ratings or scorings to that particular individual or a company. So it's purely because it's an arrangement, but it does not talk about what is the real difference between these two companies that makes them more and more of ordinal kind of ranking. Just if I want to say a company with a credit score of 800 versus a company with a credit score of 400. It says yes, this company is having a high credit worthiness compared to this company, but probably it cannot help me in saying this company is having twice double the credit worthiness of this company, because these are ordinal rankings. You cannot use them as an arithmetic comparison, but you can very well use them as a relative kind of a comparison, saying a company with a credit rating of 800 is much stable or much better credit worthy compared to a company with a credit rating of 400. To that layer you can very well work out with. And when we talk about the credit scoring models, generally they are used for individuals and smaller businesses. The reason being, it's a one single number based on various aspects. It's one single number, and probably it does not take into consideration any kind of economic aspects, life cycle, or probably business cycles. None of these things are typically incorporated into the credit scoring model. Typically we have a FICO kind of a model, which is a very solid model in the United States, wherein a score of probably a 660 or higher is typically treated as a decent credit score, and anything below that falls under a risky kind of a credit score for the individual. And the credit scoring models are specifically every individual wants to improve their credit scores, and sometimes they may be more and more, the credit scoring companies may be more and more pressurized to improve the credit scores of the individuals as well as the lending organizations. And so many, when it comes to the credit ratings, then any organization can get the credit rating. Even a corporate can get the rating, or government can get the rating, and in some cases this ratings can be issuer pay kind of ratings, which means the the party who is raising a capital, who wants a loan, borrower pays to the credit rating agency to get themselves rated. It means government will pay a credit rating agency to provide a rating to the government. A company XYZ will pay something to the credit rating agency to give a rating to it based on its financial situation. But here there could be a possibility of conflict of interest, because I am paying to get myself rated. There is a possibility that the rating agency which has taken a fee from me might give a favorable rating to me. But in this process, the credit rating agencies are actually selling their reputation. The credit rating agencies, their entire bread and butter is on the worthiness of the ratings that they typically give. So there is a high chance that they don't get into the traps of giving this kind of favorable ratings to the issuers. So we don't need to be that much worried about this particular aspect. So either the corporate or the government or even ABS, asset-backed securities kind of instrument. We'll talk in detail about the ABS slightly later in another session. All these securities, all these borrowers, wherever a borrower is involved or wherever a lender is involved, there is a possibility of credit ratings coming into picture. So they are very good summary measures of risk, because there are two major rating agencies in the United States, the S&P as well as Moody's. They give a credit ratings. So probably a AAA, AA plus, some such kind of ratings which typically indicate which typically indicate the worthiness, probably up to a triple B kind of a rating. We see that these are all investment grade kind of ratings, and probably once the double B or B kind of rating starts off, these are more and more of non-investment grade kind of bond, more of a speculative grade kind of a bond. The same equivalents are given by Moody as okay A1, AA2 kind of rating, and up to let's say BAA3 is what is the typical investment grade for a Moody, and probably something like BA1 even to C and D. Moody goes up to C, whereas S&P goes even up to D. So all these things typically are the speculative grade kind of bonds. So different rating agencies, especially these two, are highly popular in the United States, and every country has a different set of rating agencies. Like this, let's say in India we look at CRISIL, ICRA. Again, there are a few more rating agencies which are more and more popular. So these, whatever the ratings that they are giving out, they are more and more of summary measures of risk and whatever they are giving, they do not adjust with the business cycle. And in order to bring in more and more stability into the credit rating models, it might so happen that these rating agencies, they reduce the correlation between the various default probabilities. Probably there might be a possibility that if the first year there was no default, then the second year the chances of default could be higher or lower. By reducing the correlation of the default with the default probabilities, you find that they are trying to bring in more and more consistency or stability into the rating model. And typically they are very easy to understand compared to the structural models, which we will be discussing slightly later, because they are just one single number or one single one single value assignment. So easy to understand. Whatever may be the business, whatever may be the complexity of the financial transactions involved in the company, they, at the end, when I look at one single credit score or credit rating, it looks as if I can summarize the entire company's operations, or probably I can do the comparison of two different companies' credit risk quite comfortably. And what we have already said is, because they work out with the reduction in the correlation with the default probabilities, they try to maintain stability over time, which means the volatilities are more or less addressed to a large extent. And even the reduction in the correlation with the default probability, that is that is a compromise that is being done. So it's a weightage between, or it's a trade-off between the bringing in more stability into the rating, or let the rating vary by incorporating the correlation at different aspects with respect to the different default probability. Because with the economy, there is a possibility that the correlation between with the default probability could be either higher or lower. But if I am reducing that correlation, then obviously the rating would be more and more stable. So the reduction in the correlation with the default probability is one of the main weaknesses of this credit rating model. And as I said, this will not adjust with the business cycle, because they have made it more and more stable. But we have already said that the probability of default and loss given default, they typically change quite drastically with respect to the business cycle. So from that perspective, we have to typically be a little bit cautious about the credit ratings that have been given by these agencies, understand them thoroughly before using them for our interpretation purpose. The next set of models which we typically look at for measuring the credit risk is a structural model. Very interesting set of models. And when we talk about the structural model, the model is based on the balance sheet of the company. So we are looking at the financial statements and especially the composition of the debt as well as equity, which form the total assets. It's a very interesting discussion here. Probably you assume something like this: a company which is having some amount of debt and some amount of equity. These two, the value of the debt plus value of the equity, should be the equal to the value of the company, which is the value of the assets of the firm. Now, at some point in time, if the value of the assets is greater than the outstanding debt, whatever is remaining, typically I should write it as the value of the equity is equal to the value of the assets minus the value of the debt. It might so happen that the value of the asset, the market value of the assets of the company, may be higher than the value of the debt or may be lower than the value of the debt. So, what can very well happen here is, if at all the assets are greater than the value of the debt, probably because the equity investors are having the residual stake on the interests of the company, on the assets of the company, it might so happen that if the value of the assets is greater than the value of the debt, in case the assets are sold off, probably the whole debt can be paid off to the lenders, and the remaining whatever is left will typically go to the equity investors, right? Now, in case the value of the assets is lesser than the value of the debt, because of the equity investors having a residual and the final claim on the assets of the company, the assets are much lesser than the debt that needs to be paid off. So it might so happen that the equity investor ends up receiving nothing. So if the value of the assets is going up, the equity investor will receive more and more. But if the value of the assets is going down, the equity investor will receive nothing. Probably this is resembling more and more of a call option. This is resembling more and more of European call option on the company's assets. So equity, for an equity investor, the position is equivalent to an European call option on the company assets with a strike price equal to the outstanding debt or value of debt. So when the value of the assets is greater than the value of the debt, the excess entirely belongs to the equity investor. Value of the assets is less than the value of debt, the equity investor will end up getting nothing. So this is how we look at a structural model. So when I have to model the equities position, all I am saying is it is as good as valuing a call option on an equity security. Instead of equity security, here I am talking about call option on assets of the company. Again, for a call option, I need to know the strike price. So with a strike price or an exercise price equal to the value of debt. That is how a structural model looks like. And how do I value this call option? Probably for option pricing we have variety of models. So I can use, let's say, a Black-Scholes kind of a formula to typically value this particular option and say this is the worth of the equity. So this is the value of equity in this particular investment, because we say that is the worth of the call option. So here call option is similar to the value of the equity. So this is the worthiness of a structural model. We are based on the balance sheet. What all numbers I require here? The assets, the debt and the equity breakup. So based on them, I am trying to see that equity can be modeled. That is why we call them as structural models. The equity investment in the company can be modeled as a call option, European call option on the assets of the company with a strike price equivalent to the value of the debt. Right? And similarly, it is also said that if at all a company is owning a risky debt, it is saying that you own a risk-free bond and write a put option on the company's assets with a strike price equal to the face value of the debt or value of the debt that is outstanding. So in that case, what is happening? When I am writing a put, I am selling a put. So it is beneficial to the buyer. It is beneficial to the buyer when the value of the asset is going down. Right? When the value of the asset is going down, it is beneficial to a buyer, which means to a seller, because you have sold a put. It is beneficial when the value of the put is going, when the value of the assets is going up. See, when the value of the assets is going up, okay, we'll see, you have a risk-free bond and you have written a put option. So when you have written a put option, you are actually getting a premium. So which means what you are getting at the initiation is an additional amount for the riskiness that is inherent in the risky bond. So as long as the value of the bond is increasing, you will still get the risk-free value in the future. But if the value of the bond has decreased, you will get only the value of the assets, which means when the value of the bond has decreased, as a writer of a put option, you are going to lose up. So which means you will get only the asset value, which might be much lesser, and it may result in an overall loss. So there are two dimensions. If at all I am modeling a debt, a risky debt, I say that its position is equivalent to having a risk-free bond and then writing a put option on the company's assets with the strike price equal to the face value of the bond, face value of the debt. So that's where we say the value of the risky debt is equal to the value of the risk-free debt as well as the value of the put option that I am writing on the top of it. So even for this also we can go ahead with a Black-Scholes based option pricing formula, because writing a put option. So for a put, what is the formula for a value of the put option? So when I am talking about debt, the value of the put option is the value of the asset times n of minus d1 plus k e per minus rt k e per minus r into 1 minus t n of d2. So we have the put option formula, or probably we can find out the call option and then use the call put parity to find out the put option relation. All we are trying to do with respect to the stock is, wherever we are talking about the stock price, we are looking at the price of the asset. Wherever we are looking at the strike price, it's the same as the strike. Here the strike price is made as an assumption of the value of the debt. So when I am writing this is like more and more of the present value in case the default occurs, and this is the present value of the payments in case the default is not going to occur. and the weighted probabilities associated to each one of them. N of minus d1 is the case where the default is going to occur, and this is the case where the default is not going to occur, and based on that we are trying to find out what is the value of the debt. The same way we can look at the value of the equity, which is modeled as European call option. So debt is modeled as European put option, along with owning a risk-free bond with a strike price equal to the face value of the bond. Whereas equity is visualized as European call option on the assets of the firm with a strike price equivalent to the value of the bond. So whenever we talk about the probability of default, the probability of default directly comes out as 1 minus ND2. That is what is a measure of the probability of default. But here I need to work out with to find out ND1 and ND2, I require the mean return on assets and the variance of the return on assets. So these two things are slightly difficult to compute kind of stuff, because historical returns of assets are not available. So we have to go ahead with more and more of internal estimation mechanisms, kind of calibration techniques internally to arrive at these two values. So this is a challenge when we are trying to go with a structural model, because we are if we are talking about a call option on a stock, the stock prices are available on a daily basis because it is heavily traded. But when I am looking at a total asset value, the value cannot be obtained directly. So there is a lot of internal calibration model that has to go in to arrive at the formula for these kind of structural models. And some of the key assumptions these models deal with, they assume that the risk-free rate of return is constant for the entire period, which is a very far away from reality, because it's also the case because it is using a Black-Scholes kind of an option pricing formula to find out the value of the equity, and that constant interest rate is one of the assumptions of Black-Scholes formulas also. So even this models, all these structural models, they make an assumption that the interest rate is constant and the assets are traded very comfortably in a frictionless market where mu and sigma squared, the mean return of the assets and the variance of the return of assets are quite comfortably calculatable. But the reality is that is the major difficulty. And typically this because of R changing quite drastically, or because of inability to trade mu, inability to trade the assets and get mu and sigma squared on a continual basis, may not be relevant to the real world at all, and they do not consider the business cycles, because we are talking about R being completely constant for the entire period. And the biggest thing is, just from that option pricing formula itself, I can think of what is the probability of default and what is the loss given default, and it can quickly help me in terms of arriving at the expected loss and present value of expected loss and all these things. So that's the strength of the model, but at the same time a couple of limitations associated with the model needs to be overcome in order to use this model for the assessment of the credit risk of the company, right? And when it comes to the next set of models, which is the reduced form kind of models, they are much better off compared to the structural models, because one of the key assumption in a structural model is the assets are traded in a frictionless market and it is easy to find mu and sigma squared. Whereas when it comes to the reduced form of models, that's not the case. They do not go with any kind of restrictions on the inputs, but they majorly focus on the restrictions on the output of the model. So they generally go with incorporating the real world scenarios into the model, because here when I am looking at the debt using the reduced form kind of a model, it goes simply as the face value of the debt divided by the multiplication of 1 plus R1, 1 plus R2 for each of the periods, different interest rates. There in those models, the model assumes that the interest rate risk-free rate of return is constant, whereas this model does not assume that the risk-free rate of return is constant. So it is assuming that the interest rate is more and more of stochastic. So if I have it can be treated as a stochastic process, which means it can very well vary, and probably using a stochastic prediction model, I can very well if I am able to predict the interest rates for the future, they can very well be incorporated quite comfortably into the model. So we tried, because a lot of input data can very well be taken from the historical data. You can very well assess the hazard rate quite comfortably in this model and use it for the determination of the credit risk. And this makes an assumption that the interest rate need not be constant for the entire period. It is stochastic, means based on the status of the economy, the interest rate can very well go up or go down, which means the probability of default also can very well be increasing or decreasing depending on the state of the economy. So that is one major variation that this model brings into. And when I look at the strength of this model, typically I can use the historical estimates, the credit risk changes with the business cycle, and there is not too much of dependency on the balance sheet of the particular company. But the biggest problem is whatever the hazard rate we are trying to form based on the historical data, it requires to be backtested, it requires to be formulated properly in order to use this kind of thing for our reality purpose. So the thorough testing on the model has to happen if it has to be used in the real world applications. So the next thing which we look at is the concept of the credit spread, which is typically talking about the difference between the yield of a zero coupon risky bond and yield on a zero coupon risk-less bond, risk-free bond. So that is what we are talking about as a credit spread. And when we talk about the word term structure, it's a very common usage. Term structure is with time. Across various levels of maturity, how is this credit spread changing? Is it widening or is it narrowing? So that is what is the term structure of the credit spread. So basically we should look at a bootstrapping kind of a process, just like we used spot rates and determined the spot rates from the bank bond rates in a typical bonds examples. The bootstrapping is a mechanism using the coupon bond prices for both risky as well as risk-free bonds, try to find out the spot rates, and using those spot rates try valuing the bond, using the YTM try valuing the bonds, whatever the difference that is coming up is what is contributing, and we can value the bond, risk-free bond as well as a risky bond, and whatever the YTM of a risky bond minus the YTM of a risk-free bond, we can call it as a credit spread, or that constant difference that comes with respect to the spot rates of each of the maturities is also contributing to the credit risk of credit spread of a particular bond. So what we generally do is we try to work out on the present values of the credit spread to understand the present value of the expected losses also. For each of the periods, I can take the credit spread, I can discount that from the credit spread, the simple logic to work out is, let's say there is a risk-free rate of return and I have a credit spread for this particular year. So this will form as the risky rate of return. So whatever the cash flows that this particular bond is going to give in periods 1, 2, 3, 4, one, I discount them with the risk-free rates of return to arrive at value of a risk-free bond, and I take risky rates of return by adding risk-free rate plus the credit spread. I discount the bond, the cash flows of the bond using the risky rate of return, and whatever the differences that come up in the value of the bond at each of the phases, I add them up to give me the credit, the present value of the expected losses that are present in that particular bond, which is a measure of the credit risk that is inherent in the bond. So that is what is the mechanism that is typically used in case of finding out the present value of the expected loss, which can be used as a part of valuing the credit risk inherent in the bond. And just as a small note, when we talk about asset-backed securities, the kind of analysis that you may have to do is slightly different from the analysis you do for the other loans, because there is a backing of the asset, underlying asset, there is a backing of that. So there is a very rare chance that there is a default on the ABS, only the ABS will go low in value. So there is a loss when the default occurs in the collateral pool, but we do not talk about as default. There is only a reduction in value. So that's where in our entire formulas, let's say in the expected loss, where we have used probability of default into loss given default. So we generally update it here saying probability of loss into loss given default. We don't say probability of default, because there is nothing called default when we talk about asset-backed securities. It's only a reduction in the value. So we have to take that into consideration when we are going ahead doing the credit analysis on asset-backed securities. So this is what I can talk about, a very brief analysis of the credit risk models. If you have any further queries on the same, you can get back to me by giving me a call on the number given below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.